Oh my gosh, the market completely freaked out this week in some ways to what Jerome Powell said, and in other ways did absolutely nothing. So, what I want to do is look at what is happening in the negative and what is happening in the positive based on Jerome Powell's statement on Wednesday. Hey guys, RC Peck here, and I want to talk about some statements that came out on Wednesday. And I want to talk about first the positive things that are happening in the market. That's the first. And the second is the negative things that are happening, and ask ourselves, are those short-term negatives or are those really a shift in the market going forward for the second half of the year? So let's look at those. And even if you don't care about Jerome Powell, or you're 30 years old, or you're 90 years old and you're in bonds, what makes most sense is to really understand when words come out like that, that's news, right? Jerome Powell, what he says matters. He's the chairman of the Federal Reserve in the U.S. Central Bank. So what matters most is what is reacting, what is acting, and it helps you understand how news and information really impacts price and portfolios. So let's get into that. Let me do this. Let me move over to screens, and I'm going to just start with a really simple screen here, a really simple price chart here. And this is just the total stock market in the US. So it's thousands of stocks in that black squiggly line. And the first thing I just want to point out is you can't really tell something happened. Right? So this is the good news, right? Yes, Jerome Powell came out. Now what he said specifically on Wednesday was, hey everyone, instead of us raising the federal funds rate in 2024, right? That's somewhere between 30 and 42 months away from today. We're thinking of raising it in 2023, which is 18 to 30 months away. So he's upping it 1 year. And the other thing that was interpreted is that, hey, in 2023, we're going to increase rates twice. Now, rates are at 0, so that means they'd be at 0.5%. So at the first bluff, that doesn't really mean much, right? At 0 to 0.5%, no biggie. But the market did not expect that. So when I say the market, we'll look at bonds, we'll look at a couple different things. But here's the U.S. stock market. You can tell nothing really mattered. U.S. stock market's about $50 trillion in size. And as you can see, it's down a little bit. I mean, you'd have to squint to look here, guys. But it's down a little bit, what are we talking, 2%? So not that big a deal. Let me just quickly check international all world ex-US. So all world ex-US is down 3%. So just super rough, about twice as much as the US. So what we know is the US wasn't affected as much from the statement coming out of Jerome Powell as international. Okay. Next thing I want to look at is let's just go look at just the sectors, the 11 sectors that make up the U.S. stock market. Now, this is what they've done this year, right? So this calendar year to date, this is what they've all done. And you can see that big bar in the middle, that's energy. It's up 29% year to date. And then you have financials over here, and then you have real estate. But these are, okay, and we got communication services over here. But as far as the top 3 out of these 11, energy is the clear winner at 29%, financials up 9%, real estate up 11%. Now, if I just go to the last 3 days, right, since the announcement, which was Wednesday to close the market Friday, so that's 3 trading days, you see a flip. You see energy doing the worst, down almost 5%, and financials down almost 4%. And then the things that are positive over the last 3 days are things that maybe weren't up when we looked at year to date. Healthcare's up, technology's up, discretionary's up. The only thing that's positive during both periods, and I'm just looking at 2 periods here, everyone, the last 3 days and the last 117 trading days, or just year to date. Interesting enough, the one that's up for both of them is communication services, which in very much an odd way, it's really kind of a technology-ish sector. If you look what's in communications, it's Google, it's Facebook, it's stuff that most people would think of as being technology. But this is what we have. So the question is this a shift? Is there a shift because of what he said. And so what we want to do is just let's look at a couple things. Here's XLF, because XLF was up big for the year and it's been hit pretty hard. I'm going to look at financials and I'm going to look at energy. So here it is here. So a couple things prior to this drop here, and this drops about 8%. Prior to this drop, the financials are up about 22% for the year. So they're still up way more than the overall market. But you can see visually that's a pretty big drop. Not much different from this drop here. That was an 8% drop. This is about an 8% drop too. So financials are getting hit just like they were hit at the beginning of the year. So the short answer is we don't know yet. Right? Oftentimes what you see with the lead sectors is they take bigger hits when the market corrects. Right? So the market overall is down about-ish 2%. Financials are down about 8%. And then if we look at energy, energy is a little different because energy has a lot of work. It has to kind of move through all of this noise in its past, where financials are at a new high. Energy, since the announcement, just quickly checking, is down. I'm going to round here. It's down about 6%. But energy is also the strongest sector this year. So it's actually handling itself much better than financials. And because there's a lot of, I'm going to call it noise between, I'm looking at XLE. There's a lot of noise between, let's just say easy math, between $50 and $66. This type of volatility is to be expected. So the takeaway right now is financials and energy definitely got hit the worst based on Jerome Powell's comments on Wednesday. And of the two, right now, energy is looking the best. Now we'll see if it holds up. What we do know is it closed down on Friday, closed down on Thursday. The general rule is you can learn a lot on a Friday close because you learn to see what people do and do not want to hold into the weekend. Okay, now what I want to do is I want to jump over to the yield of the 10-year Treasury because I got asked this question this week, like, what do you think about inflation? I said inflation in what? Right, so is it inflation in rates? Is it inflation in commodities? Is it inflation in single-family homes? Is it wage inflation? So it really depends what inflation you're looking at. But if you look at the screen here, this is the yield of the 10-year Treasury. Probably the most followed Treasury or bond on the planet. If you can see here, there was a bottoming. The yield on the 10-year could not get below 1.4. And each time, it happened 3 times, it got down to that kind of the 1.4, 1.5. What happened is the yield popped up. And then in COVID crash last year, it broke through. And then at the beginning of this year, I'm squinting here because we're looking at 30 years of price data. It popped up. It broke back above that 1.5%. So here's the thing. I think this matters really a lot in regards to what the Fed's going to do. Because if the yield is below, and let's just say for easy math, if it's below 1.4. So 1.4% is really the go, no go yield on the Treasury to determine if the Fed's going to do something. And this is how I want you to think about it. If the 10-year Treasury is yielding 1%, do you really think the Fed's going to increase rates a 0.5 point? I don't think so. They increase rates when that black line is going up. And it's very likely, I thought rates would really kind of live between 1.5 and 3%. So if you look at the screen, 1.5 to 3% is the bottom blue line to the top blue line. The top blue line is 3%. The bottom line is 1.5. And I was making a prediction like, look, it's going to live between 1.5 and 3. Now, look, if it can't stay above 1.5%, then it's actually a new channel. What we may be looking at is that the yield on the 10-year Treasury is really going to be between 1% and 1.5%. That means bonds are going to continue to struggle, right? They're not going to pay a lot out. They'll be opposite when the market falls. But I'm really looking to see where's the new rate that the Fed's going to hold. And I say it this way because if you look at Japan, Japan's ahead of the US in managing rates. Here's the Japanese 10-year yield. And you can see it's gone sideways since the beginning of 2016. That's 5.5 years. They've basically said, look, we're keeping it right around zero. And today it's 0.06. So they're managing the yield. Let's see what we got here. Here's Germany managing their 10-year, which they're managing their 10-year to stay basically below zero. And so in a world of Germany paying you negative 20 basis points, okay, Japan paying you 6 basis points, or the US paying you 145 basis points, where do you think money's going to go? So it's very likely the Fed won't raise, but they did throw that out there and it did scare financials. So to me, the big question on whether financials fall even more, or if they lead if they lose their leadership, is if this gets below 1.4 and stays there, meaning it breaks down below 1.4% yield, it tries to get above and it can't. And so that's really what I'm looking at now. The other thing that I have kind of interest in, and I've talked about this before, I talked about this on a call, my June call with my research clients is, hey, if TLT breaks above 140, that's a significant point. And so I was talking to my members about the $140 mark. And I said, it's, and I was a little vague. It's like, okay, it first has to break it, then it has to kind of test it. So it broke it and it tested it. This pullback was the test of it. This does not mean the market's crashing. And I'll get to that in a minute. Does not mean the market's crashing. It just means long-term bond prices are going higher, which is pushing the yield lower. So people are moving into those longer-term ones where if you look at, say, a shorter-term U.S. bond, 3 to 7 years, you don't have any movement. You don't see anything. And then if we go to a 7 to 10 year, you see a little bit more of a movement. It definitely popped above kind of that 114, but it has not broken up and out. I'm not saying it will or it won't, but it just hasn't done it yet. So the question is, what parts of the market are being hurt and will they be permanently hurt? So the first is, let's just take VTI, which is a total U.S. stock market. Nothing really is being hurt in the overall market. And if I take the market and I divide it by just the U.S. bond market, so now we have the U.S. stock market divided by the U.S. bond market, really there's not a lot of weakening. I mean, maybe at the most from right now we see from a U.S. total stock market, a 5 to 10% correction. But that's really, I don't see a lot going on. There's not a lot of panicking going into bonds. Maybe there's some shifting between the type of bonds. But right now, it's really, yep, we got it, Jerome. You might raise rates in 2023, which is 18 to 30 months from now, which is different from what you said before, which was 30 to 42 months from now. And if you did raise rates, there'd maybe be 2 quarter-point rate rises. Rate rises? Is that even a thing? But again, I go back to the 10-year, and man, if the 10-year is yielding below 1.4, which let me put it at 1.4 here, I don't see the inflation. The other thing too you have to think about then is what is he and his group of Fed governors looking at? And it may be, let me actually bring up CRB. This is the commodity index. What we'd most want to see here if this is going to continue to stay strong is, this is the CRB. This is the Reuters Jeffrey CRB index. So it's an index that tracks the commodity index. The commodity index is 40% energy, 40% agriculture, and 20% metal. And what you want to see is this index above 200 to kind of cement that prices are going to stay elevated. Now, I've talked before how I think this is a clean out to the downside. And the longer the CRB index stays above 200, the more likely it is it will move higher. So we'll see. So there's definitely movement going on. Allergies are killing me this week. I mean, you may hear it in my tone. But really what we're looking at is the Fed made an announcement. Okay, we got that. Energy and financials did not like the announcement. Okay, bonds moved up, so bond prices are moving higher. The long bonds like TLT and zero coupon bonds, you can track that ZROZ, are moving up the strongest. And so what it's telling us right now is there may be a shift, but we're only 3 days into this, and we want to see if financials and energy are just kind of correcting back down as they move back up, or was that their finish of that and they're going to hand the baton back to growth? And let me actually I'll save it for next week, looking at growth and technology. The one thing I did want to say that I'm just going to edit because we're getting kind of long here is one thing that's interesting is semiconductors are not breaking up and out, which they usually lead technology higher. Semis are really in a sideways pattern. So that has not broken out yet. So guys, thank you for being in my world. If you like the video, please like it. Leave a comment. It helps with the old algos behind this to get it in front of more people. And leave a comment. Tell me where I'm right. Tell me where I'm wrong. Be specific. Just don't say you're wrong. That doesn't help me, guys. Like, this is a learning experience for all of us to look at the markets and really understand what is and is not working. And guys, if you like this, you'll love my free course, Clarity and Control. It's what it sounds like. I work with men and women over the age of 50 who realize they want control back over their finances. They want clarity back over their finances. Check it out, and I'll see you on that video. And if not that one, I'll see you on my next video. Okay, thanks.